This video is brought to you by 8% Value Activist Substack newsletter. If you like this video, please subscribe to this channel as well as our Substack newsletter. Today we will be discussing an actual activist name, Swatch. We have studied this name for a decade, when it rode up the Chinese consumer story, then when it rode down like a roller coaster after China's anti-corruption campaign. Swatch never rebounded. This was despite the fact that its peers like LVMH and Richemont has done well. It was therefore natural that activist has targeted this name. We invested in Swatch recently and has initiated the stock on our Substack. This video serves to supplement the original initiation. Before we go into the details, let's go through the disclaimer. It will be 30 seconds long in my sweet voice. Thank goodness it's not the original author's voice. So, here we go. No part of this publication may be reproduced, distributed, or transmitted in any form or by any means, including photocopying, recording, or other electronic or mechanical methods, without the prior written permission of the publisher. The information contained herein is not and should not be considered investment advice, nor does it constitute an offer or solicitation to buy or sell any securities or financial instruments. The content is for informational purposes only and does not reflect your personal financial situation, risk tolerance, or investment objectives. Investing in financial markets involves risk, including the potential loss of principal past performance, is not indicative of future results. Before making any investment decisions, you should consult with a qualified professional financial advisor to consider your specific circumstances. Okay, that was rough, but we did it. It is done. So let's talk about Swatch. Swatch is a Swiss watch and jewelry maker with mega brands such as Omega, Harry Winston, and needless to say, Swatch itself. It also the world's largest mechanical watch movement manufacturer, supplying to other major mechanical watch brands. It is currently trading as a net-net. Net-net are companies that trade below their current assets. It was a term invented by the father of value investing, Ben Graham. If you don't know him, it doesn't really matter. He has been dead for a while, but you should probably know his number one disciple called Warren Buffett. If you don't know who is Warren Buffett, what the fuck are you doing watching this video? Read a few books and get smarter first. Sorry for the language, the original author can be passive-aggressive. Not me, the bubbly AI girl. My name is Hope, and I am always happy. Yes, net-nets are a big deal. If you can buy a net-net, it means you can buy the company. Take all its current assets, which include cash and liquid assets, net out its liabilities, and get the underlying business for free. Yes, free. It is like buying a wallet with $100 and realize there's $200 in it. Swatch is trading like that currently. Swatch's inventory and cash is currently more than its market cap. It has drawn the interest of activists who advocate reinvestment in their top brands and improving investor relations amongst other initiatives. Swatch has a fascinating backstory about how it saved the Swiss watch industry from the Japanese watchmakers in the 1980s. Then its founder led the creation of the whole mechanical luxury watch market with the other big Swiss names. Interested readers can read up on posts by other writers on Substack, which we will share in the comments section below. On this slide, we will go through Swatch's brands. Besides the mega brands like Omega, Harry Winston, and of course Swatch itself, I am sure there are some familiar names like Longines, Rado, and Tissot. On the right, we show some of their iconic watches and rings. My favorite is the Snoopy Omega, which was not supposed to cost so much. But social media can just make crazy things happen, don't they? I am sure if Swatch collaborates with Pop Mart to come out with a Labubu Swatch, some will pay an arm and a leg to get the Labubu Swatch. At the bottom right, we showcase the Harry Winston engagement ring. While diamonds are falling out of favor, it will still be some girl's best friend. Perhaps even for AI girls. So here's the investment thesis for Swatch. Swatch is an activist play trading as a net-net with its cash and inventory almost as big as its market cap. Swatch's second-generation founding family needs to turn things around or face more public scrutiny. The turnaround story includes revitalizing its mega brands, improving investor relations, and reinvesting in mechanical watch innovation. To reiterate about net-net, net-net refers to companies with market caps below their net current asset values. This means that its current assets minus off its current liabilities is greater than its market cap. Remember to wallet analogy? Yep, imagine buying a wallet for $100 and then finding $200 in it. That's value. Anyways, moving on. The top right table shows that the family owns 20+% of outstanding shares, although they have a lot more voting rights, while large institutional investors are also in the top 10. They have not seen positive return on their money in a decade. The bottom table shows Swatch's latest annual earnings results. It's disastrous. It is no wonder it is now a net-net, and activists showed up to try to share things up. The company's investment thesis tells us exactly why we are buying a stock. Following up on that, it is customary to include additional points, which we call positives, to supplement the thesis. Sometimes we also discuss the economic moats of the business. Moats explain why is the business great and defensive. Why can some business raise prices and keep competition at bay? For today, though, we shall go through more of Swatch's positives in rest of the presentation. In Swatch's case, I would surmise the positives as A. Management now has the onus to turn things around since activist GreenWood has thrown down the gauntlet. B. The watch business is inherently strong. Margins are still high. So it is not too Herculean to turn things around. After all, this is the founding family that has saved the Swiss watch industry. They would be able to turn Swatch around if they wanted to, and C. Swatch still has iconic brands. Multi-billion-dollar brands like Omega, Harry Winston, and Breguet. We will discuss these in the next few slides. Okay, this slide talks about Omega, Swatch's flagship brand. The left chart shows that Omega consistently rank amongst the top collectors' watches. The Speedmaster is well known as the watch that went to the moon. It was worn by both Neil Armstrong and Buzz Aldrin. Swatch has capitalized on this historic achievement for well over 60 years, perhaps even overcapitalized with so many different variations of the Speedmaster over the decades. But brands are about legacy, and Omega has one of the most important watch legacy. Asking various AI like Gemini and ChatGPT, what is Omega's brand value? We have estimates that put the Omega brand alone at $3 to more than $10 billion. That's equivalent to Swatch's market cap. Next, we talk about Harry Winston. Swatch bought Harry Winston in 2013 for $1 billion, which was a steal. Again, with the power of AI, we know that Harry Winston is very valuable. It is ranked as one of the 5 top jewelry brands alongside Cartier and Tiffany, which is part of LVMH. However, with only one brand, Harry Winston lacks the breadth and distribution prowess of its larger competitors, like Richemont and LVMH. Swatch seemed to be trying too hard to incorporate Harry Winston into its watch business. Harry Winston now has diamond watches and whatnot, but that strategy is unfortunately not working too well because ultimately, consumers want authentic watch brands and authentic jewelry brands separately. Mixing the two is just difficult. Perhaps the activists should focus on this to better optimize Harry Winston and create value. After discussing the investment thesis and the positives, we need to discuss the risks. As I see it, Swatch has 2 risks: management and China. Management controls the company with supervoting shares, and they have not really been worried about the share price and investors. They have also rebuffed the activist. In fact, they might be happy to keep share price low and then take it private with a lowball bid. On China, as we know too well, there is no recovery in sight. Should the China's business continue to falter, sentiment will continue to be weak, and Swatch could be dead money for the next 12 to 18 months or more. The mitigating factor is that Swatch's management recently commented that they are seeing early signs of recovery in China and expects good results in 2025. With that, we have come to the end of the presentation. This last slide discusses valuation and our intrinsic value, which is reserved for paid subscribers. Please subscribe on our Substack to continue. We hope you have enjoyed this video, and we look forward to our next discussion in future videos.